Gentleman from Illinois is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here again. I think this is a very important topic that I certainly want to understand, and I know my colleagues do as well. Just to recap, I think my understanding is pretty clear from your testimony, from the questions, that certainly for investors, two of the most attractive features of money market funds are stable NAV and also liquidity. Also seems fair to say that these features, if they're compromised by floating the NAV or imposing gates or fees, we would likely see, most of you had said this, we would see money flow out of the products and we'd see less demand for money market funds. Mr. Stevens, I wondered, this movement out of money market funds, would that also be seen in institutional prime funds as well as municipal funds?
I think it would be across the board, assuming that the requirements were applied uniformly, particularly if they were applied in combination. And we've given a lot of thought over these past 5 years to where the money would go. One of the convictions, I think, particularly for retail investors, that it would flow into bank deposits and probably be concentrated in the largest of our banks. Yeah. With respect to institutions who have more alternatives, there are private funds that they could use. There are offshore vehicles that they could use. None of them have the transparency or the regulation that are characteristic of today's money market.
Let me Treasurer McCoy, if I can ask you a quick question. If we expect an exodus of investors from municipal tax-exempt funds, couldn't this mean a cost spike for state and local government financing?
It would. Anything that would reduce the demand for our issuance of bonds would increase our borrowing costs.
So it's really the potential is the new rules could indirectly burden our constituents, the taxpayers, with higher costs for states and municipalities. Is that true?
Absolutely. It would drive up our borrowing costs.
Okay. Mr. Stevens, jumping back to you, quoting from your testimony, the SEC's, and you stated, release proposes to exempt government money market funds from further structural reform because of, among other things, the following. Government money market funds are not susceptible to the risks of mass investor redemptions. Their securities have low default risk and high liquidity, and interest rate risk is generally mitigated. Could the same be said of municipal funds as well?
Yes. In fact, we believe that the municipal security market reflects many of those same characteristics. In addition, we've looked at the Detroit bankruptcy, the experience in September of 2008, and the problems in Orange County historically, and have discovered that those major shocks in the market did not precipitate outflows en masse from tax-exempt money market funds.
Ms. Chandraha, in your testimony, I gather that you would agree with ICI's conclusion that municipal money market funds are particularly resilient, to quote your testimony, and don't pose a systemic risk. Is that true?
That is true. I agree with what Paul said, is that the municipal money funds are much more liquid than prime funds, so they're far more resilient. They proved that in the financial crisis. We didn't really see flows there. They're also, they represent 10% of the whole money fund industry. So they're very small relative to the entire industry, but yet have outsized importance for state and local governments to finance themselves.
Okay. Treasurer McCoy, I wonder if you could help me further understand. I have met with some state treasurers, but want to ask if you could briefly lay out the implications of the SEC's proposal for local government investment pools, or LGIPs. The LGIP structure won't be familiar to everyone here, and the effects of the SEC's alternative proposals certainly, I believe, could pose a significant risk to participants in LGIPs, potentially harming the finances of those municipal entities. Could you tell us just briefly, I only have a few seconds left, of if you see this as a potential harm and a concern we ought to have?
I think every state that manages an LGIP would look at this very seriously. I think that we will, as state treasurers, we would work with GASB to see if we could encourage GASB to change their rule to be more like the Office of the OCC rule for bank stiff funds, which does describe and require a stable NAV using just by using amortized cost accounting. So it would we would be moving in that direction to see if we couldn't get some relief there.
My time is about to run out, so I'm going to ask if I can follow up with some written questions and ask for your response. One in particular is NAST is concerned with the SEC's proposed elimination of the 25% basket, returning to a 10% limit, effectively could cap municipal debt held by a single MMF, regardless of creditworthiness. So I have some questions about impact again on taxpayers, on our constituents. My time has expired, and I yield back. Thank you all very much.
Gentleman's time has expired, and the chair now